Hello, I'm Darius McDermott, Managing Director of Chelsea Financial Services, and I'm delighted to be joined by Ken Wotton and Bevan Duncan, who are managers on the Baronsmead range of VCTs. Hi guys, how are you?
Morning, Darius. Thanks for having us.
Morning, good, thank you.
It's great to speak to you. VCTs are a little bit more complicated than your average fund. What is it that you guys look for when investing in a VCT versus a normal fund? And Ken, I should say, you're very well known to our video watchers as the elite rated manager of the Gresham House microcap and multi-cap income funds. So you also run funds. What's the difference on the VCT?
I think the VCTs, the key difference is that these are tax efficient products. They are beneficiaries, the investors in the funds are beneficiaries of a tax break, which is designed to promote investment into smaller and earlier stage companies that might not otherwise get investment. And therefore, the focus of the funds is on growth businesses that in due course will contribute to tax revenues and employment in the UK. And that's the background to the reason for the tax break.
Of course. Maybe what describe, and I know sort of Bevan, you're more of the private equity background, and Ken obviously the listed side. What sort of characteristics do you look for? Do they differ on the listed and unlisted? And are there any sectors in which you focus? Maybe Ken, you go first.
Sure. So we, as a fund which invests in both publicly listed companies and unlisted companies, we think there's a real advantage in joining those activities together and trying to leverage the greater touch points and the wider team and the network that we have as a business by operating in both those markets. So we typically focus on the same core sectors, and we have a number of core thematic areas that we focus on where we think there's tailwinds to growth in the economy, and those apply both to public and private companies. We typically focus on businesses that are fundamentally profitable business models. So with the capability of generating cash, they're not businesses that are sort of startups or really, really early stage, which with no prospect of making a profit anytime soon. And again, that's consistent between the public and private investments that we make.
Evan, would you like to jump in and talk about what it is on the PE side?
So absolutely. So as Ken said, we're following the same sort of investment themes and sector focus, and we're really looking to back businesses with great growth momentum, and our job is to come in and help maintain that growth and accelerate it. So we focus a lot on really backing high quality, high potential management teams that we can work alongside closely to really help them sort of deliver and execute their plans.
Great. Now, it's been a very interesting year, 2020. What have you done at a portfolio level? What changes or adaptations have you made?
Well, we've worked extremely closely with all of our management teams. So on the private equity side, we've got board representation for each of the companies that we're invested in. So we've sort of helped them navigate through the pandemic. And as Ken said, we've got a really large diversified portfolio. So we've got great insight from how different businesses in the economy was reacting. So we fed that back into our companies to help them sort of try and get ahead of issues and anticipate sort of second order impact, but also increasingly sort of take advantage of opportunities that the dislocation and the disruption in the market sort of presented. We are quite sort of focused on sort of software and technology enabled businesses, which have been sort of more resilient through the pandemic, and we continue to expect that to be the case sort of going forward. We're sort of really focused on sort of managing that downside risk, increasingly now looking for opportunities which are presenting themselves.
In the public side of things, we spent the early period of the crisis trying to get close to the management teams and really understand what they were doing and how they were thinking about planning for the uncertainty. And then as a result of the market volatility that we've seen, there's actually been a significant number of opportunities to back businesses that we believe in have good long-term prospects at attractive prices, And if you're taking a long-term view and you can see through the short-term disruption, and a number of our VCT qualifying AIM companies have actually come to the market to raise money, but done that on the front foot because they've seen opportunities to take investment into the business to grow faster through this period.
Now, I think we've touched on this a little bit already, that one of the things where Baronsmead is a bit different on the VCT side is that you have this listed AIM part of the portfolio and the private equity unlisted part. Maybe touch on that a little bit more, but also how Baronsmead have adapted to the 2015 VCT rule changes.
In terms of the quoted and unquoted portfolios within the Baronsmead funds, you're right, we are distinct from the other VCTs in the market because we have both of those asset classes at scale. And what that's meant from an investor's perspective is actually you've had a very complementary profile from those different asset classes over the long term. It's been complementary in terms of the deployment that we've made. So when we've had opportunities to invest, it's been complementary in terms of the profile of divestments, and it's the divestments and the capital profits that we generate from selling businesses that generates the profits we can then pay out to shareholders as dividends. And as you can imagine, private assets have a more lumpy profile, but the publicly listed companies were able to take profits and top slice those investments through the market, and we've done that actively during 2020. And then lastly, the performance has been complementary. So whilst both asset classes have performed well over the long term, they've done that on a slightly different trajectory, and that means that from a shareholder's perspective, that's smoothed out some of the volatility and therefore the consistency of returns, and again, the consistency of the dividends as what they've experienced.
Bevan, maybe if you just touch then briefly on the rule changes that came in, moving or insisting that venture capital money goes into that earlier stage investment and less into sort of management buyouts and slightly more mature businesses. How have you adapted to that on the PE side?
Yeah, so there's been quite obviously significant change, and we're now operating sort of in part of the market that's highly fragmented and it's a high volume of opportunities. So first of all, we think it's really important to be quite focused investors on parts of the market where there's a long-term structural growth, but also where we as managers have got deep expertise, track record, and network. So we're selective about where we invest, but we've also adopted a model where we're making a greater number of investments, but smaller day one checks, and then basically increasing our amount of invested capital as that business matures and scales. So really matching capital with potential investment return and upside.
And finally, then maybe if we could just touch on the current raise and the dividend policy going forward. As you say, dividends can be lumpy depending on disposals. What is the dividend policy for the Baronsmead range VCTs in a world where cash is zero and government bonds are next to zero?
The dividend policy, what the board uses as a target for setting the dividend, is 7% based on the opening NAV at the start of that financial year, and paid in two dividends, so one with the interim results and one with the final dividend. We know that dividends are a key sort of feature of the Baronsmead VCTs, but we think they're sustainable because of the scale and the diversification that we've got in the portfolio, and our ability to take profits in quoted markets as well as those lumpier sort of private equity sales. So we think that the dividend is sustainable on that basis, but we also think, to your point around, we're raising capital at the moment. So there's a joint fundraising, so £40 million between both VCTs, up to £25 million. We do have a larger over-allotment facility of £35 million that we can utilise if the demand is there, but it started well. But we think it's going to be a really good time to be investing. We sort of touched on some of the opportunities we've seen in quoted markets, but it's similar in unquoted. Entrepreneurial businesses, they're run by ambitious, more agile management teams are quick to sort of maneuver when there's a change in the market to take advantage of that change. They want to be well funded and have a equity partner that's supportive and engaged, which we are. So we're really quite excited about the opportunities to invest over the next 12 to 24 months, and we want to be well capitalized to take advantage of that.
Perfect. Well, listen, Ken, Bevan, thank you very much for talking us through VCTs and the way that Baronsmead invests in them, with that quoted and unquoted part of the structure. And good luck with the raise, and see you soon.
Thank you.
For more information on the Baronsmead VCTs, please visit chelseafs.co.uk.